You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Pets at Home, Cranswick, Assura, Britvic, Halfords, and our US company of the week is Zoom. Sam, shall I kick us off with Pets at Home?
Absolutely.
Okay. So one of our more favoured retailers, I would say, they had their first half year results out last week with first half revenue up 7.3% to £727.2 million, with like-for-like growth up 6.4%. There was growth across both vets groups and retail, with online rising an impressive 16.2% to 16.5% of retail revenue. Meanwhile, store revenue grew 5% to £535 million. Sales of food increased, with revenue rising 15.1% to £336.7 million, with 8% rise in food tonnage, advanced nutrition up 14%, and own label versus branded up around a quarter. Need-driven services grew, with vet practice sales growing 7% and dog grooming up 4%. Accessory spending, however, fell 2.5% to £257.7 million. The VIP membership scheme saw members increase 9% to 7.6 million, and sign-ups to Puppy and Kitten Club averaged 29,000 a week towards the end of the period. Despite this, underlying pre-tax profit was down 9.3%, in line with expectations, with higher freight and energy costs and increased digital investment. The group generated a free cash flow of £41.4 million, down 54.8% on last year, with higher spending and lower profits. Net cash, excluding lease liabilities, stood at £43.1 million. An interim dividend of 4.5p per share was announced, which represents a 4.7% increase in last year. In terms of valuation, Pets at Home has a market cap of £1.4 billion and trades at 14.5 times forward earnings, compared with a 10-year average of 16, and it yields nearly 4%. I thought these were decent results in the circumstances, but it's certainly not easy with all of the inflationary pressures feeding through. I think it's also interesting that, as the group have pointed out in the results, 3/4 of pet care spend is non-discretionary in nature, and also historically, pet care, or the pet care market, has continued to grow despite economic cycles. I'm also beginning to appreciate the membership and the veterinary model more and more, which both seem to be working well, and there seem to be genuine synergies, which, unlike some companies which had tried this sort of thing before, Tesco's, for example, in that hypermarket model that they had, putting gyms and giraffe restaurants in the stores, it seems to work well and complement the business as a whole. It's probably not enough to make me buy the company, and it's still, where we are in the cycle, quite pricey. And I think there's going to be a tough few years ahead, especially with the accessories and those discretionary items being cut back. But as a retailer, I do rate it. Sam, what are your thoughts on Pets at Home and these results?
Pretty similar. I think the results are decent in that they could have been a lot worse, and I suspect we are going to see retailers with results that are a lot worse in the next 6 to 12 months. I think the profit fall is just, I don't really see what they can actually do. I don't think they can really pass on all the price increases to the customers, because you're just pushing them towards switching to online. So they're in a bit of a tricky position there. You'd hope that the freight and energy costs are temporary, so profits will normalise eventually, and they're just going to have a couple of tougher years in the meantime, potentially. I think the only figure really where I look at it and say they actually have control of that, and that is a reflection of how the business are doing, is probably that VIP memberships, and 7.6 million is a lot. So I think the only figure really that you can fairly use to judge them, they're doing well on. I think the valuation's okay. The dividend yield's pretty good, getting on for 4%. But I just think a forward P of 14, there are some very, very good retailers that we do cover regularly. You know, I'd say like Next and Kingfisher, Dunelm spring to mind, that are around that price range or cheaper. So I just don't think I'd ever get to a point where I wanted to pull the trigger on pets at home, because I just think if I wanted, there'd be something else I could get if I wanted that retail exposure. I feel like I could get a better business for cheaper. I do agree though that the vet side of the business is complementary, and I do like the acquisition strategy on it. I think it makes sense. I certainly like it a lot more than a business we'll be covering later's acquisition strategy, without spoiling anything.
Do you think that there's a bit more sort of structurally behind the pet market and the care associated with it that sort of underpins that slightly higher valuation when it comes to pets at home compared with some of those other retailers you mentioned?
Possibly. I think there's a bit more of a convenience factor. There's a bit more of a comfort factor as well, because I think you've got this trend, haven't you, with the millennials, where the pets are like the babies, and then they're just not having babies as a result. But you do, there is something to going in store and actually chatting to a staff member that knows their stuff, I think. And I think when this animal is your baby, you don't just want the cheapest dog food available that you can get on Amazon. That's not what there will be some people that do that, but that's not what the majority are doing. I think, if you take someone where they've gone and bought they've got a nice fresh puppy, they walk into the pets at home, they sign up to the VIP program, they sign them up to the vet group, they've got that convenience, it's nearby. It's probably going to take quite a lot to switch it. You probably wouldn't switch just because it's cheaper online, because then you've still got to go back for the vets and stuff. And it's just, I think it's smart, and maybe a bit of a premium, but I think the Puppy and Kitten Club is smart that they're doing, where they're getting 29,000 a week at the end of the period for that, because that's, if you can get them in for life, people will spend a lot of money on their pets. But even still, should this business trade at a premium to some of the businesses we've looked at, like Next? I know it's a completely different business, but I'd say Next is a better business. Yeah, no,
I would agree with you there. But as a retailer, it's up there. It's one of the ones I like on the FTSE.
Yeah. Should we move from the animal to the plate now?
Yeah, Cranswick.
So we have covered them before. They are I think it's mainly pork and poultry that they do. They have come out with their interim results, and the highlights included a new £32 million whole breaded poultry facility successfully commissioned at the start of the period, with retail and food service customers now on board, and further investments in the group's pig farming operations with self-sufficiency now at more than 40%. In terms of the numbers, revenue was up 12.4% to 1.116 billion. Adjusted group operating profit was down 1.7% to 68.4 million. I did have a look at the adjustments. They seem pretty reasonable. It's stuff like valuations in like biological assets and stuff. So I agree that should be adjusted out. So the adjusted figures do actually look like the ones to use. The adjusted group operating margin is down from 7% to 6.1%. The adjusted profit before tax is down 3.4% to 66 million, and the adjusted earnings per share is down 4.7% to 98.6p a share. In terms of the statutory results, statutory profit before tax was only 2.7% lower, and statutory earnings per share was only 3.9% lower. They highlighted the return on capital employed has dropped from 17.8% to 15.9%, and the net debt now stands at 61 million, and that compares to 36 million in March and 18 million a year ago. The results for the halves over the past 3 years, and that does include, I'd say 2 years ago it was a bit more of a COVID year. Revenue has gone from 2 years ago 931 to 993 to 1.16. Earnings per share 92p to 105p to 98p. Free cash flow 90.6 million to 79.1 to 46.9. The debt's gone from 121 down to 87 up to 136. In terms of the split of revenue, they get 25% from fresh pork, 19% from poultry, 16% from gourmet products, 39% from convenience, and just 1% from pet food, which will be covered a bit later. So it actually does link quite nicely to pets at home. They've talked about how stable the margins are. So if we go back 6 months, the adjusted gross margin, and I appreciate you can adjust it to whatever you like, but assuming the adjustments they've made every year are similar to the ones this year where they actually look quite sensible, gross margins, and these are 6-month changes, 12.4%, 13, 13.4, 13.8, 13.1, operating margin 6.2, 6.2, 6.7, 7, 6.1. So it does look fairly consistent. This is quite interesting. So it's the sales to the different supermarkets. So they supply the pork and the poultry that you might buy on the shelves at Tesco or whatever. So the sales to the supermarkets, and this is versus 2019. Tesco's up 13.9%. Sainsbury's is up 14.9%. Asda's up 6%. Aldi's up 26.7%. Morrison's is down 0.2%. Lidl's up 38.2%. And M&S is up 13.4%. So they're selling to all of the big boys. I don't know where that growth has come from. I don't know if we're eating more meat or it's just they've switched from other suppliers to Cranswick. But either way, those are good figures. And it does look like they're pretty dominant because they are in all of the big supermarkets. And you get to a point where you just get to a size where, if you're a big supermarket, who can you actually reliably supply you except for Cranswick? There's an interesting, it's better in the slides, but there's graphs showing the average retail price per kilo for the different types of meat. And compared to 2021, poultry's got 14.6% inflation, pork's 8%, beef is 8.9%, lamb's 11%, and fish is only 5%. But the beef, the lamb, and the fish, although the fish is the lowest, it's the highest per kilo. So actually the poultry and the pork, although it's gone up quite a lot per kilo, it's still by far the cheapest meat, which is quite good for Cranswick, given that is what they're supplying. They've shown the volumes for the half as well. So pork was down 2.8%, convenience was up 4.2%, gourmet products 2.9%, and poultry 0.5%. What's interesting about that is they have increased sales about, 12% or something. That's pretty much all come through price increases, it looks like, which makes sense given the inflation figures they're quoting as well. And they've talked about diversification. So they have completed the acquisition of Grove Pet Foods on 28th of Jan 2022, and an £8.6 million investment is due to begin shortly at the manufacturing facility to expand and support growth plans. And they've said strong progress is being made in securing a significant new customer. It'd be quite nice if that was pets at home, actually. That would link very, very nicely.
Synergies.
Absolutely. And then during the period, a legacy private label customer decided to exit the business, resulting in the impairment of a £3 million of customer relationship intangible assets. I don't know much about the pet food market. I imagine it's pretty saturated. However, it looks like the advertising is along the lines of like high quality pet food. Given that they have all the meat themselves, I would expect they can deliver on the high quality food. And if not, it's not a big acquisition. It's 1% of revenue. This is something where it could be very nice if it works, but if it doesn't, there's not really much downside. So I quite like this strategy. I think it fits in well.
Most of our pork is imported, with Denmark the dominant supplier over a quarter of UK pork imports.
And there is a big push at the minute for British. It's got bigger, as you can imagine, since Brexit. But for British pork, they're basically, if you can produce it, you're going to sell it. There's not really any issue there.
And Denmark, Germany, and the Netherlands combined account for 60% of imports.
Well, there you go. Potentially a decent growth market with Brexit. We should have put together a Brexit portfolio. This would have been in there, wouldn't it? Cash flow. So they've had a net cash inflow of 11 million. That compares to a 32 million outflow. However, that includes borrowings of 36 million. I sort of understand why management do it. They do it for consistency and stuff. But I do not like it to see in the cash flow statement 36 million of borrowings, 28 million dividend. I just think just don't pay a dividend this half. It's really not a big deal. But anyway, then that's asking too much, clearly. But I think that was that was everything. So in terms of the valuation, currently trading at a PE of 15 and it has a dividend yield of 2.45%. However, as highlighted, it is borrowing at the minute to support that dividend. Although that being said, the debt is still very low. The total debt, it's very much in the manageable range. So it's not really anything to worry about. I just don't like it. John, what are your thoughts on these results and Cranswick as a company?
I mean, they seem reasonable. They're not as good as they have been over the last few years. And they've been able to pass on most of the inflationary costs through price increases. I don't know much, or I don't know enough, certainly, about the meat industry in the UK to know how much of a growth market it could be and the competition there, and also what might happen if you did have any, say, trade deals. Possibly one with the US could be some way away, but if it did happen sooner, does that massively disrupt things for Cranswick? I don't know. I think those things would probably put me off investing in it at the moment. But I wouldn't say never with it. And the other thing I was wondering about is, does the economic climate, does that affect the amount of the amount of meat being consumed? Is that something? Is that a trend? I don't know. A few too many question marks for me at the moment, Sam.
See, I'd counter the economic climate one with, I mean, they're not really pushing the meat substitutes in these results. Yeah. So that's not, I'm sure I could find it out, but it's not been provided. But I think there's maybe a strong argument that people would switch from the more expensive meats to the cheaper ones in the economic climate. And the cheapest two meats are, at the moment, pork and poultry, although I appreciate pork does fluctuate a bit more than poultry. So you could maybe argue they're more likely to be beneficiaries of the economic climate. My view is I actually like the business. I think it's quite a well-run business. I like the acquisitions. I don't think the valuation's outrageous, but it's quite similar to Pets at Home. And I mean, obviously it's not a retailer, but I just think at 15 times earnings is probably better businesses I could buy. So it's not that there's anything wrong with Cranswick. It's just the opportunity cost. There's a lot of businesses I'd want to own before I got to Cranswick.
Fair enough. Okay, then. Another business. I'm not convinced you're going to like this one, Sam. We've covered its peer, which is Primary Health Properties, but this is Assura, which is FTSE 250 listed. It's essentially medical real estate, or a medical real estate investment trust. They own a lot of GP surgeries and pharmacies. That accounts for more than, I think, about 90% of their business. They had their interim results out for the 6 months ended 30th of September, with net rental income up 15% to £70 million and EPRA earnings up 20% to £49 million. And for reference, EPRA is profit after taxation attributable to shareholders of the company, excluding investment and development property revaluations, gains or losses on investing and trading property disposals, changes in the fair value of financial instruments, and associated closeout costs and their related taxation. The investment property portfolio itself grew 5% to £2.87 billion, with LTV increasing by 2 percentage points to 38%. Net yield is roughly 4.5%. The group made £141 million worth of additions in the period, £113 million of these acquisitions and £28 million development completions. The group also completed £73 million worth of disposals at the end of the first half, which were completed at a small premium to book value. In terms of rent review results, the group averaged 4.5%, and the group noted linkage to cost inflation on new developments, creating evidence for rental growth, but taking time to flow through to the settled rent reviews. And the group points out that their activities going forward are focused on asset enhancements, developments, and rent reviews as areas that they can add value to their portfolio. The portfolio is made up of 81% GP surgeries and 8% pharmacies, with the rest independent providers and others. Net debt stood at just over £1 billion, 38% LTV at a weighted average of 2.3%, and with a weighted average maturity of 7.5 years. Net debt to EBITDA stood at 8.7 times. In terms of valuation, Assura has a market cap of just over 1.6 billion and trades at 13 times earnings, yielding 5.6%. I thought these results were good on the surface, with net income rising and rent effectively underwritten by the government. The level of debt is high, though, and over 8 times earnings. And from that perspective, its peer, which is actually, well, they're more or less the same size. PHP, Primary Health Properties, looked like a healthier business. I think if we talk about the sector more generally, which is dominated by PHP and Assura, on the bull side, though, for the sector, the two big players being Primary Health Properties and Assura, is that 45% of surgeries and healthcare centres are still GP owned. So there is a lot of room for expansion, and that currently 30% of healthcare centres aren't fit for purpose. Moreover, if you look at the number of GP consultations per year, it's estimated to be in the region of 350 million, which is more than double what it was in 2008. And also from a demographic point of view, the UK population of people aged over 85 is predicted to be more than double by 2040. I think on top of this, most younger GPs don't like the financial commitment of owning or buying into a surgery and prefer to lease. Like a lot of other things in millennial life, it's a lease. So I think those things do create a bit more of a bull case for those two companies. I think Primary Health Properties, though, is a better one, and I wouldn't be choosing Assura, especially with the debt and rising interest rates. Sam, what were your thoughts on these results from Assura and the industry as a whole?
I thought the results were quite good, in that I think the net rental income up 15% year on year is quite good, especially when the average unexpired lease is 11.5 years. I don't know if they've got something in the contracts where it's just rising with inflation. Presumably it must, because otherwise they're negotiating very hard on those new leases to get an overall 15% increase. So I think that's quite good. I was, whilst you were talking, I was umming and ahhing about the debt and what my actual view on it was, because for a normal company, I would say that debt is way too high. But when it's rental income and you've got the leases locked in on average for 11.5 years, it's less of an issue. But yeah, with net debt of 1.09 billion, my issue would be firstly the rising interest rates, like you've said. But then if you look at those figures, their net rental income is 70 million, but the profit before tax was only 30.9 million. So I think the difference is the interest that they're paying. So that only leaves you 30 million a year to chip away at the capital if you wanted to, which they're probably not going to do, because I think if it's a REIT, then they're required to pay out 90% of it as a dividend. Yeah, I don't like it. I don't recall the PHP results well enough to be able to compare them, but my gut feel was that PHP, I certainly don't recall it being as unhealthy. But it does have net assets. The loan to value is only 38. So even, if they sold all the assets tomorrow, providing it wasn't a fire sale and you got the actual market value, it's not in any serious trouble, but it's, how much of your earnings are basically going to be chipped away by the interest or your dividend, because you are just buying it for the income, really. So yeah, I do think they're interesting businesses, but in this particular scenario, I agree. I think the interest is just going to it's going to suck a lot of the dividends up in the next few years, unless the current situation changes significantly. Okay,
on to a company that we do like, Britvic.
Yes, Britvic. I think it is fair to call Britvic a favourite of the show. So Britvic have come out with their full year results for the year ended 30 September 2022. For anyone who doesn't know, Britvic is they do a lot of the drinks in the UK. I think a decent number of our listeners will have drank a Britvic product this week. So they've got the Pepsi, they've got like the 7-Up, Robinson's Fruit Shoot, J2O. The list does just go on and on and on. So they have come out with their full year results, and revenue was up 15.2% to 1.618 billion. Statutory earnings before interest and tax was up 26.2% to 192.4 million. And the statutory earnings before interest and tax margin is up from 10.8 to 11.9%. The basic earnings per share is up 45.5% to 52.6p, and the adjusted earnings per share is up 29.3% to 57.3p a share. And the return on invested capital is up from 15% to 16.4%. If we break the results down by region, because the business is split into Great Britain, Brazil, rest of the world. In Great Britain, revenue was 1.1 billion, and that was up 15.1%. And that compares to total 1.6 billion. So the bulk of the revenue is currently coming from Great Britain. Volumes were up 5.5% to 1.79, might be billion now, which 1,790 million litres. Average revenue per litre was up 9.1% to 61.4p. Brand contribution was up 11.8% to 426, and the brand contribution margin was down to 38.7%. In Brazil, the revenue was up 15.7% to 143 million. Volume was up 3.8% to 299.3 million. Average revenue per litre was up 11.4% to 47.8p. Interestingly, that's not far off the Great Britain amount of 61.4p. I would probably expect that to be lower. Brand contribution was down 0.9% to 22.7%, and brand contribution margin was down from 18.5% to 15.9%. And the other international, which consists of France, Ireland, and other international markets, revenue was up 16.5% to 374.9 million. Volume was up 9.8% to 428 million. Average revenue per litre was up 2% to 87.6p. Brand contribution margin was down from 31.8 to 28.5%. They split the two halves out. So in the first half, volume was up 10.7%. That was only up 2.2% in the second half. But the revenue was up 18.5% in the first half and 13.1% in the second. So it was like in the first half, they were very fortunate. They got to benefit from the increased volumes, and they upped the prices too. Whereas in this half, the volumes were up a little bit, but most of the extra revenue came from increasing the prices. They highlighted that they've got 2 additional carton line and additional grape processing facilities in Brazil. They highlighted that Ireland had double-digit revenue and brand contribution growth, and France had double-digit revenue growth offset by inflation, resulting in significant margin pressure. Highlighted the leverage peaks during the pandemic as earnings before interest, tax, depreciation and amortization declined. Strong recovery in debt was well within the guidance range of 1.5 to 2.5x. So it's currently at 1.9x, down from a height of 2.1x at the pandemic. I'm not sure it's really gone down, actually, because the revenue's gone up quite a bit since then. So it might just be that the revenue's just made the debt a smaller proportion because the EBIT has gone up. But anyway, they've said for 2023, they expect the cost of sales inflation to be low double digit. So that means we'll probably be seeing double digit price increases. And they expect to maintain a 50% payout ratio, and they're completing an initial share buyback of 75 million. So they've only just started doing share buybacks. I think this is the first year in which they've done them, which is quite interesting because the market cap, it's 2 billion. So 75 million, that's it's about 3% a year they're chipping away at it. But on top of that, the dividend yield's 3.5%. So you're getting 6.5% of your capital back a year if you combine the two. So that's a pretty decent return, actually. And they've highlighted their total shareholder return. So they've compared themselves to the FTSE 250, which is the index they're in. Over 10 years, Britvic's grown 170% compared to 76.4% to the FTSE 250. Over 5 years, Britvic's up 10.7%, and that compares to an 8.8% decline for the FTSE 250. And over 1 year, they're down 17%, but that compares to a 26.8% decline for the FTSE 250. Now, we've always liked Britvic on the show. I think we both would have said it is one of the better quality businesses on the FTSE 250, and the results reflect that. It's beating the market over 1, 5, and 10 years, which isn't necessarily something you'd expect from Britvic, I think. And in terms of the valuation, it now trades at a PE ratio of just 14, and as mentioned earlier, that dividend yield is 3.54%. My view is I think these are excellent results. The first half was a little bit better than the second because they were increasing volumes as much as prices, but I wouldn't expect that to continue. My only complaint really would be that I would have liked seeing slightly higher growth from Brazil, as for me, that is one of the most exciting things about this business, that I think Brazil could be a very, very big market. I think that international side of Britvic is what makes it much more interesting than, say, AG Bar, which is probably the closest listed competitor. But I think these are very good results, but I would like to see them being a bit more aggressive in Brazil. But hopefully with the new plants and stuff, they will actually hopefully start doing that. John, what are your thoughts on these results and Britvic as a company?
Yeah, I mean, I think they're fantastic results. Perhaps because it has Brazil, you'd maybe have those expectations would be that little bit higher. Otherwise, it's difficult to fault it. I think it's extremely high quality. It's got some very strong brands. And yeah, it's probably going to go onto my watch list. And actually, at 14 times earnings, it's not that expensive when you look at some of its peers. Well, they're not direct peers, but other consumer goods companies like Unilever's, which are higher teens and closer to the 20 times earnings. It's certainly a much better company than AG Bar, which we've also covered quite a few times on the show. It's probably not quite good enough for me to buy shares, but I do like it, and it's on my watch list.
I'm pretty similar. I think for me, it would be opportunity cost. As to why, I know I've said this for like every business that we've liked this week, but at 14, I do think it's good, and I think I do like the income from it. It's just there's other businesses I'd want to buy first before I got to Britvic, but I do really rate it, actually. I think it's a really, really good business. And I do like that Brazil side, although I think it can be doing a little bit better.
Yeah, I think that's the exciting part, and that's something that definitely does set it aside from AG Bar.
Should we move on to a business that we don't rate quite as highly?
Oh, are you sure?
Absolutely.
Okay. Halfords, the motoring and cycling retailer, had their half-year results out last week, with revenue up 10.2% to £765.7 million on a like-for-like basis, and 31.3% on a 3-year basis. Underlying profits before tax came in at £29 million, down nearly 50%, and underlying EBITDA fell 20.5% to £92 million. Costs as a percentage of revenue also rose 46.8%, up 3 percentage points on a 3-year basis, and finance expense also increased by 6.9%. Revenue growth was driven by the auto centres, both like-for-like business and acquisitions. Auto centres now represent 43% of group revenue, and revenue in the first half came in at £265.2 million, up 69.9% year on year and 14.3% on a like-for-like basis. Gross margins fell back 210 basis points to 53.5%, and operating costs increased 68.2% year on year. Underlying earnings before interest and taxes was £2 million, down 45.9% year on year. The group cite negative impact of business rate relief, property sale and leaseback, and the tyre market depression. Revenue from the retail division fell 7.1% year on year and 6% on a like-for-like basis, with cycling down 12.5% on a like-for-like basis and motoring down 1.5%. With operating costs up 2.4% and underlying earnings before interest and taxes down 43.1%. The group cite inflation, payroll, and investment in the digital and customer experience. The group are trying to mitigate some of these pressures and have 50% of full year 24 energy purchased. And they also comment that they're switching to LED lighting in the stores and auto centres. They hope to save £20 million for the full year. The group finished the half with £32.3 million of net cash pre-lease debt. They have £368 million of lease debt, but are operating within their net debt to EBITDA targets of between 1.8 and 2.3 times, and have £180 million of debt facility, or £180 million debt facility, which has been extended until December 2025. Alongside these results, the group announced an interim dividend of 3p per share, and going forward, they are expecting full-year profits before tax to be towards the lower end of their £65 to £70 million range. In terms of valuation, Halfords has a market cap of £432 million and trades at 8.6 times forward earnings, currently yields around 4%. I thought these results were poor and really confirm what I already thought of Halfords. We've covered it a few times now. I think it's a failing retailer, and I don't see it being around in 10 or 15 years' time. I think there's a very risky strategy that they're pivoting towards with motoring services, particularly when debt is becoming increasingly expensive, and it is a commoditized industry. Most of the UK customers buy cars on PCP or finance, over 90%. A lot of that has service included. And also, there's the trend to move towards electric vehicles, and all of those standard servicing jobs that you would have done, changing the oil, filters, spark plugs, air filters, they're going to be a thing of the past. And then you're just left with the brakes and the tyres. Also, in the short term, you could see people cutting back on the servicing, despite that, not really being, definitely not being advisable and not safe on their older cars. And then also not splashing out on more conventional push bikes. So I think the long-term strategy, I think, is wrong with Halfords. And I think it's got a lot of headwinds in the short term. I really don't like it. Sam, are there any positives to see in Halfords?
I don't think I'm quite as negative as you, but I think the acquisition strategy has been aggressive. I think we criticised it at the time. We didn't like it. And I think 13% growth on a 3-year basis, I think is crap. I really do. It's basically, if you do now compared to pre-pandemic, that's what you're looking at. They've not grown at all. So they got this big bump in the pandemic and then it's back down to reality. I don't think the tyre market is in a depression. So I think they're just doing poorly. I don't know how long the shift to electric vehicles will take. So I'd probably put them in the same category as like oil and gas and stuff, just without the abnormal profits until they go bust. But yeah, I don't know how long the shift will take. And I don't like the strategy. I think with the servicing, I think the issue is if you think that the internal combustion engine is in structural decline or terminal decline, they basically doubled down on it with the auto centres, which I think it's a bit. I didn't like the strategy in any case. I agree it's very fragmented. I don't think it's a fantastic business. As a customer, I do actually use them quite a bit. I think they do offer some quite good services. But as a business, it just doesn't reflect in the results. The longer you zoom out, the less I like the business. So yeah, I don't feel like I was quite as negative as you were, but I was still pretty negative. I don't really have much more to say if you want to move on to Zoom.
Okay. A company that we're liking more and more. How's the valuation doing and what are the results?
So Zoom, yeah. So we did cover this last time. We were very surprised by how cheap it was, actually. So Zoom, probably don't need an introduction, but video calls, we record this podcast on Zoom for a bit of an inside snippet. And actually, just as a bit of anecdotal, a few months ago, they changed the rules so that if there's two of you, you had to pay for the Zoom. and it was going to be something like £7 a month or something. So I was saying to John, well, because we were getting kicked out every 40 minutes trying to record this. So I said to John, well, should we look at like the alternatives and switching? And your preference was to stick with Zoom. Now, in the end, we found someone who would let us use their passwords so we don't have to pay. But the point is, we were willing, and we were going to pay for it, which I think if you told us that 2 years ago, we'd have said, well, why would we pay for a video recording thing? There's loads of them. But it is fantastic to use, and I can see why it is so popular. But anyway, they've come out with their third quarter results. Revenue was up 5% year over year to $1.1 billion, and these figures are all in dollars. Oh, and that's after adjusting for foreign currency impact, but they were up 7% in constant currency. Enterprise revenue was $614 million, up 20% year over year, and online was $487 million, down 9% year over year. Income from operations and operating margin, generally accepted principles, which is the account regulations. Income from operations for the Q3 was $66.5 million compared to $290.9 million in Q3 2022. Or the 2022 fiscal year, that is. The operating margin for Q3 was 6%. For net income was $48.4 million or 16 cents a share, and that compares to $1.11 a share a year ago. Cash and marketable securities stand at $5.2 billion, and that's on a market cap of $22.4 billion. So 20 to 25% of this thing is cash, basically. Cash flow, net cash from operating activities was $295 million compared to $394 million a year ago. And free cash flow was $272 million compared to $374 million a year ago. They've got approximately 209,000 enterprise customers, and that's up 14% from the same quarter last year. And they've got a trailing 12-month net dollar expansion rate of 117%. So they've got 3,286 customers contributing more than $100,000 in the past 12 months, up 31% from the same quarter a year ago. And online average monthly churn was 3.1% for Q3. For the fourth quarter, total revenue is expected to be between $1.095 and $1.105 billion in constant currency. And in constant currency, expected to be between 1.12 and 1.13. Income from operations is expected to be between 316 and 326 million. And for the full year, revenue is expected to be between 4.37 and 4.38 billion in constant currency and 4.42 and 4.452 in constant currency. It was quite interesting. So the revenue in America is growing 11% a year. And it's actually the other regions declining, which surprised me. So in Europe, Middle East, and Africa, revenue's down 9% year over year. In Asia Pacific, I don't know what the A is. Asia Pacific, it's APAC. So it's Asia Pacific. I don't know what the other A is. And China, that's down 3%. I would have expected the growth not to be coming from America, but that's not the worst thing in the world. And the revenue share by region, they are now 70.2% of the revenue comes from America, 16.5% from Europe, Middle East, and Africa, and 13.3% from APAC. In terms of the valuation, the business trades at a PE ratio of 34. However, as mentioned last time, I feel like the free cash flow is a better metric to use because they are bringing in a lot of cash, and the free cash flow multiple is only 19 times. In terms of the share performance, I can't remember when we last looked at it, but 6 months ago it was at $112 a share. It's now at 77. It looks like it's pretty much near all-time lows, so it must have gone down since we last covered it. But that's 77 compares to a high of 559 at the height of the pandemic. So this has been very, very badly treated by the market. But my view is pretty similar to last time. I think these results are decent. I think at a free cash flow multiple of 19, that's pretty good. P of 34 seems a bit pricier, but that's going to be on very depressed earnings. And I think there's a lot of figures where they are chugging away and they are moving in the right. They are just moving in the right direction. So where were they? Like the enterprise customers seem very good. The churn's very low. The number of customers contributing more than $100,000 a year, up 31%. That's fantastic. There's just a lot of figures like that have just been masked, I think, in the drop in the operating profits. But this thing's still profitable as well. So if it's struggling, it can just ride it out. And it's got so much cash as well. I think it's in such a fantastic position. I think it's in the position now where it's got so much growth ahead of it, but it's got so much cash on the balance sheet. You'd almost think, well, is it worth doing a dividend? But yeah, no, I really rate it. I think it's very, very good, and it's got cheaper since we last saw it, it looks like. John, what are your thoughts on the results in the business?
I mean, I think they're pretty decent results, but I suppose it's all what's been baked into Zoom, and everyone assuming, well, back in 2020 it was going to the moon, and the valuations got a little bit silly. It's becoming much more attractive to me in terms of the valuation, and that it generates, so, like you say, so much cash and is a very high quality business. It is for the type of companies I usually invest in. I mean, it's very different for one, but also I don't know whether I'd be brave enough to bite the bullet and buy shares in it, but I can see why you would, and it's definitely going on my watch list.
So, of the 6 companies we've discussed this week, Pets at Home, Cranswick, Assura, Britvic, Halfords and Zoom, if you had to buy one, which one would it be?
I would go for Britvic. It's a bit, maybe a little bit safe, but I think it's high quality and it's delivering a decent amount of growth.
Without being too boring, I would also go for Britvic.
Why not Zoom?
I'm just not sure with Zoom. I think the numbers are going in the right direction. It looks very good. I don't think you're taking a huge amount of risk at that price, but it's difficult. How big can it get? How much? Because it already feels pretty saturated. So how good is their ability to monetize? Revenues are still growing at a decent amount, but it's, if revenue is going to grow 5% a year and it's a free cash flow yield of 19, that is quite expensive. Really, you need that growth. And I think the growth will come back, but I just think, I just feel a lot more confident trying to guess where the market for fizzy drinks is going to go, because I think it's something people will continue wanting to drink, and hopefully they'll want to drink more of in Brazil. So it's just I just feel like I understand the business. It's an easier business to understand as well. It's very simple what Britvic do, so that's probably why. What about you?
I guess similar reasons, and the valuation makes me nervous.
Yeah. Although it is on depressed earnings.
It is on depressed earnings, yeah.
It's a good thing we didn't cover it when it was at 500, though. Who knows what you've been saying.
Great product. But, that'll be holding me back.
Well, we can cover it again in 6 months, and maybe it's got cheaper for you.
Yeah. I mean, we said that about Boohoo, and it definitely did get cheaper. Yeah. All right. Well,
right, okay.
Thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.